Keep your schedule free on the 18th of May 2024 as we have 3 power-packed webinars for you. The first webinar delves into Charlie Munger's Inversion framework on how solving problems backwards work. This is held between 10 a.m. and 11 a.m. The second webinar delves into the global electric vehicle market and its transformative impact on the auto industry. This is held between 11 a.m. and 12 p.m. The third webinar is about long duration fund and how to make debt work for you. This is held between 12 p.m. and 1 p.m. Feel free to join any of the listed webinars. See you there.
The past few years have been a roller coaster ride for the Magnificent Seven, a group of mega cap tech stocks in the US, driving both earnings growth and equity returns. Cloud migration, digital advertising, and e-commerce were the biggest winners during COVID, and the Magnificent Seven, who are the leaders in these sectors, gained disproportionately. This catapulted their stocks to astronomical highs in 2021. The management teams of these companies thought that the good times would last forever, and they invested heavily into their business and they expanded their workforce significantly. The compensation or remuneration for their employees also increased drastically because of the lack of supply of digital talent. All of this led to their cost base bloating up. In 2022, as the economy opened up and as spends shifted from goods to services, the revenue growth for these companies started decelerating, and because of their bloated cost base, they saw an operating deleverage and their margins were hit drastically. There was also a significant increase in the interest rates by the Fed due to high inflation in 2022. All of this led to their stock prices crashing between over 40 to 50% in 2022. As stated by Mark Zuckerberg, 2022 and 2023 were the years of efficiency. These companies were looking to gain a return on the massive investments they had made in the previous years, and this led to optimizing their operations and their workforce. This was the reason why there was a huge round of layoffs across all companies in 2022 and 2023. As the economy stabilized and recalibrated to the higher interest rates, the growth of these companies also bottomed out and started reaccelerating in 2023. The profit growth was much higher than the revenue growth because of the operating leverage they were seeing in 2023 because of the efficiency measures that they had taken in the previous year. The S&P 500's return in 2023 was roughly 22%, and the Magnificent Seven, just 7 stocks, contributed to 13% of the 22%, which is over 60%. Historically, it has been seen that over half of the constituents of an index would outperform the index itself. However, in 2023, only 28% of the index outperformed the index itself. The entire returns of the S&P 500 were driven by a handful of stocks. This led to the weights of the top 7 companies in the S&P 500 increasing to an all-time high of over 30%. The increased weightage of the Magnificent Seven in the S&P 500 index was not devoid of any reason though. Michael Mauboussin, a famous author and analyst, recently stated in his paper that the economic contribution of the Magnificent Seven to the S&P 500 was over 50%, whereas their weight in the S&P 500 was just 30%. Therefore, their economic contribution was significantly higher than their weight in the index, and this clearly indicates that the valuations and the prices of these companies are not at an extreme. Buoyed by increasing stock prices and enthusiasm around generative AI, these companies have again started or embarked on a significant capex spree, much bigger than anything they have done in the past. The hyperscalers invested on a combined basis close to $65 billion pre-COVID, and in 2025 it is estimated that they will be spending over $200 billion in capital expenditure. This is a massive 3x jump. This clearly indicates that the fundamental nature of these businesses are shifting and changing, and their future will not be similar to the past. Will these companies be able to generate an adequate return on investment on these massive spends? This is a question every investor has to answer while looking at these companies at current prices. Thank you for watching.